Alright, hey guys, Josiah here at EasyCaters.com, and today I just wanted to do a quick follow-up video to yesterday where I had talked about this trade on Bitcoin um, that I was following using the IBIT ETF. But basically I was bringing out the fact that we had run up here to a target I had on my chart from last week's price action, based on last week's price action, and we had just barely not reached it. And so as price was pulling back Sunday night and Monday morning, and as the market started to open in the early hours of Monday, I went ahead and bought in on this pullback here with a strong conviction that we would be going above this high over here and reaching that target. And the specific things that I said are that I believe this level was going to be reached and a significant time frame close would be achieved above that level. So if we switch to a 15 or 5 minute, you can kind of see that we came up to this level, and then we had these wicks coming into the level, and then we purged above it with a close. And that's kind of the thing I was looking for. Now it looks slightly different on each version of Bitcoin, and each, and the IBIT ETF. So you can see, it looks one way here. It might look a little bit different on the IBIT. But actually, in retrospect, my target was slightly different than what it should have been. So I think this is what I had it as, or let's see. I think this is where I had it originally. And so you can see here we purged, or we wicked above it, wicked above it, wicked above it, but the bodies were all lining up right along that level. And then finally we got the 15-minute close there, and we got, I think, 2 hourly closes eventually as well. We kind of wicked through it and closed at it, then closed above it, and then reversed from there. So this is kind of what I meant by a significant time frame close. Is at least a 5 minute. 15 is really the first one that I kind of consider more significant. And so the 15 was a beautiful. You can see that the price understands that there's a level here. There's real orders in the market that are holding price back here. Anyway, so I just wanted to mention that. Now, I think in retrospect, the actual correct measurement would have been from this point here instead of this point. And so if you look at it now, you can see that we basically came up and wicked. So the most efficient exit would have been exiting based on that projection, and you can see we had where the wicks just flirted with it, finally got closes above it here. We purged it right here finally, and then completely reversed from there. So if I had my levels drawn just slightly differently, I could have held on for a slightly higher target. And so you can see it here where on the spot Bitcoin, where it touches, finally get a close right here, a significant purge right there, and then reversal. And so this is behavior that you a lot of times will see when price is interacting with a level. You'll have the wicks going through the level or touching the level, and then finally they hold price there until a close is accepted above that level or beyond the level, if it's a level that price is interacting with, from downward movement. But anyway, so this is essentially what I expected. It, like I said, I'm not omniscient. I don't know the future. I have ways of getting some confidence about what might be about to happen, but no one can actually know the future. And you can see that, like I said, I had one version of the future projected here, and it was, you know, perhaps it would have been a slightly better outcome, more accurate if I had drawn it slightly differently and, you know, held out a few extra ticks. But in any case, it was a good trade in either way. So you can see I had really efficient entries here, fairly efficient exits up here. You know, like I said, if I'd drawn it differently, I could have perhaps exited right in here instead of exiting in here. But in either case, you know, it was, I consider that really good trading. So, so anyway, so that was the trade yesterday that I talked about, and I just wanted to review the fact that it did eventually reach that target that I mentioned, and why that would have been. So now let's get into the why part. So the why of this is the point where we enter the realm of conjecture and theory and even dogma in some cases. But the best explanation that I've been able to come up with for myself is that I believe markets move in relation to risk to reward ratios. So if you're familiar with the trading expectancy formula that I have on my website, an article about, a lot of people trade without ever being aware of this, but all trading is an interplay between risk reward ratio and probability. And your trading expectancy is based on those two factors and how your trades play to those two factors. So you can think of expectancy as average win times win rate minus average loss times loss rate, and you know, the difference between those is your expectancy. So anyway, because of that factor, that trading is based around an interplay between those factors, probability is always about the same of price moving one direction or another. But what we can control is the risk to reward ratio, or we can have some control over it. And so price seems to move in risk to reward ratios of 1 to 1 and 2 to 1. Or excuse me, 1 to 1 and 1 to 2. Risk of 1 to a reward of 1, and risk of 1 to a reward of 2. And so that's my best explanation as far as how price moves currently. Why it goes certain distances and that kind of thing. It's because of these risk-reward ratios. No one would take a position, no one with controlling a large amount of money would take a position without trading in some rational way that played toward a, you know, expected risk to reward ratio. So with that in mind, you can see here that when you measure based on certain factors, you can find where price is likely to, where these larger traders are taking a position and where their expected targets are, where their 1 to 1 is and where their 2 to 1 is. And so with that, you can piggyback on their trade. You can kind of follow along with their larger time frame trade on a smaller time frame and take advantage of that knowledge that you have about their position, or you know, what they're doing and where price is probably going to be changing directions from. Now, this is my explanation as far as how this works. That it works is something that I know. How it works is something that I've just conjectured, or you know, I've explained to myself as best I know how. But as you can see here, and the thing is that I don't know if this is bigger traders specifically, particular traders or entities like market makers. Like I learned, I studied ICT's material for a while, and he, is big about this AI that controls the market and that kind of thing. Market makers behind the scenes controlling things, and everything's pre-programmed and that kind of thing. And there may be some of that going on to some degree. I don't know if I 100% accept that, but it does seem like some of these levels are pre-programmed in, and my explanation for that would be not necessarily that it's actually programmed in so much as that it's baked in because of the way humans behave, and so one way of looking at this would be saying, okay, well, a large trading entity or group of entities took a position here, held it for 1-to-1, got out some here, and then held it for 2-to-1 and got out the rest here. Another way of looking at this would be that this is just the average behavior of every participant in the market being exhibited in the final, it's coming out in the wash in price behavior. And so the average participant is taking a position here and holding through this move, and the average participant is leaving at this point. So, and in older trading books, from 50 years ago and stuff, they talk about things like the composite man, it's kind of like a single entity, but it's actually just the aggregated behaviors of millions of individuals, all kind of having like a hive mind type of behavior. And so the composite man is perhaps the person that's taking a position here, and the composite man is holding and exiting their position here. So you can think of this as perhaps the composite man's behavior. That's one way of looking at it, and ICT thinks of it as an AI that controls it and so forth. But, there's probably lots of different explanations, and I don't want to be dogmatic about any particular explanation because we don't actually know as far as I'm aware. But, all that said, you don't have to actually know to see a phenomenon and be able to, expect that again into the future. The explanations simply help us to kind of get an understanding of what's happening, and maybe an understanding about what might be able to, or might be about to happen next. So the stories are valuable, but holding on to a specific dogma I don't think is necessary. Now, so how did I come up with this? Years ago, I noticed that during the opening range of a stock, the stock market open, say Apple. I don't know what's going on in the market today, but I noticed years ago that you could kind of take the first few candles of the day, and you could project, if you did a risk to reward ratio of the, first, entry of the day, or the, an ideal entry, then, if you just bought the break of that candle, you could hold for like a 2-to-1. And so you can see that plays out pretty consistently in a lot of stocks. Sometimes you'll be able to hold for 4-to-1. Sometimes you'll be able to hold for, 1-to-1, or, whatever. But the intraday movement of stocks does seem to have some relation to the entries from the morning. So that's something that I noticed, that stocks move relative to prior movement. They move in multiples. I guess you could say they move in standard deviations relative to prior candle movements. And so measuring the deviation down here gives you an idea of how much deviation can happen above or outside of that range. And so that's something I noticed years ago. And more recently, in the last couple of years, like I said, I started studying ICT's material, And he, and ICT's channel is here, and I suggest his material. I think it's really good. He has a very deep understanding of price action. He's not, I don't think he should be thought of as like the perfect trader or something like that, like some of these people seem to worship him and so forth. But he does have some interesting material hidden here. If you go into the playlist section and go through some of the previous materials, he talks about, his theories about why markets move, and his viewpoint on liquidity and that kind of thing, controlling or being the influence behind price movements. And so I started studying that, and about the same time I came across this other guy, Tristan, on YouTube, who had this theory about Feigenbaum projections. And this guy has, a specific method that he's developed for predicting, forecasting price movements. And so I think the way that he does it is that he will look for, specific, something like this right here. He'll look for the highest close and the lowest close. So, this guy Tristan, I think, is some type of doctoral student, and he would take the way his methodology is something like taking the highest close achieved here before a perturbation or like a disturbing of price, I think is what it kind of refers to it as, like like price will be moving in one direction smoothly, and then it'll be kind of manipulated one way or the other. Like you'll have a wave up, a wave down, kind of, taking liquidity, and then you can project from those points to where price will likely go next. So it's something like, looking at this type of range, or the distance between these closes, and projecting, and he has specific ratios that he enters in to his Fibonacci's that he can project up and find from there where price might go to the upside, to the downside. And so that was kind of an interesting thing to me, but I found out, it seemed to me that those numbers that he entered were not magic numbers in any way. They didn't seem to have any significance other than, some theory or something in his doctoral work, and that I don't think price moves according to some magic numbers. I think price is more human than that. And so in any case, I found his work and I found it interesting, but I didn't think that he necessarily had any special answer. It was just, he was, noting some, some price behavior that seemed to follow, follow some type of pattern, and he was able to, find some interesting, repeating patterns based on that, and build this theory about Feigenbaum projections off of that, and theory about how to draw them and where to anchor them to, and that kind of thing. But from that, so that was, like ICT has his own methods for projecting targets based on the Asian range overnight. He'll take the Asian range because he sees that as like the market maker's range, something like this. I'm not an expert in ICT by any means, but he has some, he gives some significance to the Asian range or the overnight range, and uses that to gauge where price might go the next day during regular trading. And so this was similar in a way to Feigenbaum projections from Tristan, projecting where price might go. And but what ICT taught me was that the markets are moving based on market makers, or whatever this entity behind price is. It's moving according to their method of trading, not according to the retail trader's method of trading. And so from that, after just messing around and playing around with these different theories for a while, I came across this idea. I basically, I don't know where it came from, but I have never heard it elsewhere. But I basically just realized, well, if market makers are taking the other side of retail traders' trades, or this whatever this entity is taking the other side of our trades, excuse me, then they have to be buying on downward movement and selling on upward movement. And so instead of measuring, the candles that we retail traders might trade based off, as a trader, I might buy the break of the high of a candle and sell 2 times that risk amount above right here, But what ICT kind of made me realize is that the measurements need to be based on the way that the larger entities in the market are trading. And that is based on the negative space. That is based not on a candle, but on the space below candles. Or, and one way to look at that would be, that the price is, if the price is the positive space, the negative space would be where price is going to go later. I don't know if that's coming through clearly or not, but in any case, the way that I started looking at this was when price goes below a low. So you can see here we have a high, low, higher, high, break. When price goes below that low, we break broken trend, and all of this can be thought of as buying. And so this is buying. Somebody is taking the other side of all these trades, and that realization allowed me to start measuring what the entities that are buying drops, measuring their positions, their risk to reward ratios, and that allowed me to see where price might be going in the near future. So that's the essence of this, that this is a combination of looking at things through ICT's an ICT lens to see what market makers are doing, or the entity behind the market, the composite man, whatever it is, and then using something like Feigenbaum projections to measure the risk amount that this entity has taken, and project what their aim is, or what their price target is for the whatever asset it is. And so that's what this is. That's the backbone of this. Another thing that I realized is along the way is that the Feigenbaum projection ratios and all that are not necessarily important, and I don't think necessarily that Fibonacci numbers are that important either. I don't think there's any magic numbers per se. What I think is going on is something much simpler, much more human, like I said, and it's just that prices move in risk-reward ratios, and humans have ratios that are very common, would be like a 1 and a 2, and so I think what's going on is that price moves in 3x increments to whatever the risk amount is for this composite man. Okay, so that's an interesting thing. And then another thing that I noticed is that thirds seem to have some type of significance. And so I started thinking along these lines, and I'll go into this more in future videos, but I started thinking in terms of, well, if price moves in thirds, what are those thirds? And so you can think of Fibonacci's or these ratios as having meaning in a way. And the meaning that I think I have determined here is that the lower third can be thought of as discount, the middle third can be thought of as fair value, and the upper third can be thought of as premium. And so price is going to be accumulated in discount and distributed in premium. And when price retraces, it's going to typically retrace to the 50% fair value area. If it's going to do a deeper retracement, a lot of times you'll see that it comes down to the lower third to discount. And so you can see that this is an accumulation range here, this lower third, and then if you project that 2 times above, this gets 3 times that range is the target. But if you look inside this range and divide it into thirds, then this becomes the discount of the accumulation range. This is the fair value of the accumulation range, and this is the premium of the accumulation range. And so the midpoint is the middle of fair value, basically. And so I think now what I've come to the conclusion of is that ranges basically are thirds of something. They're either a 3x, or they can be divided in thirds, or they can be multiplied by thirds, by threes. And so if you take this range, this divided into thirds gives you premium and discount for this range. And you can further divide each of those ranges in thirds and so forth ad infinitum. So that's the way I've started to look at this, and so you can use this to subdivide and go farther and farther down and find areas on, projected from daily time frames but traded on intraday time frames. And so that was an interesting realization. And anyway, so that's the general framework of how I've been looking at market price movement for the past couple of years now. And so I wanted to give a quick intro to that, and I'll go into more, try to clarify it a little bit more in future videos. Anyway, in the meantime, I hope this has been helpful and interesting, and I will talk to you next time.